2.0. So the question is, will stacking 2.0 have impermanent loss when stacking STX as a liquidity provider to farm Bitcoin?
Yes. So I think there are a couple of things there that I should separate out. One thing is that Stacks 2.0 uses a very different consensus mechanism. It's actually consensus between two blockchains. It's consensus between Bitcoin, which is kind of like the base chain, and the Stacks chain. And Bitcoin miners on our system, they actually mine on the Bitcoin blockchain, right? And they mine using Bitcoin. And the best way to, in my mind, the best way to model mining for us is it's kind of like a BTC STX exchange pair directly on the Bitcoin blockchain. Miners are bidding in Bitcoin. So a new block is coming out and they see what is the value of this block. And the value is the newly minted STX, the Coinbase rewards, plus the transaction fees and the smart contracts that are executing, right? So they know that some amount of STX is up for grabs and they can actually bid and there's a live bidding mechanism on the Bitcoin blockchain. And there's a verifiable random function that picks one of the miners that was bidding. And over time, they figured out, what's the probability for them to win the bid. And they will only mine if it's cheaper for them to get STX from the BTC STX trading pair on Bitcoin versus a Binance or an exchange. In some ways, just like a DEX, right? Like you will only make a trade on a DEX if it's cheaper for you to do it on the DEX and then do some sort of arbitrage with the centralized exchanges and so on. So our mining kind of works that way. And in the process of doing the Bitcoin bidding, because you're sending Bitcoin transactions, you're actually securing the Stacks blockchain data on the Bitcoin chain, right? So that's how we designed it. The Stacks holders are different, right? Stacks holders, it's very different from proof of stake, where you're not processing blocks, your funds are not up for slashing, you don't have to worry about funds getting slashed during the process. You basically lock up your STX and you periodically broadcast certain useful information on the network, right? And you can either delegate or run a full node yourself, right? And when you do this, you're getting a Bitcoin reward on your STX holdings, right? Which is very interesting because the Bitcoin that the miners were using to bid, it's actually going to the STX holders, right? So if the smart contracts are taking off, meaning more smart contracts are getting used, the STX holders are getting a higher yield than Bitcoin. So we released a model that basically plays with these different variables. And I think if, let's say one variable is how many STX are participating in consensus, let's say 50% is, and then there are some other variables around how many miners there are and so on. Even if you take a lower value of STX transactions and the smart contracts, you can get something like a 9 or 10% yield on your STX holdings, because it's mostly driven by the Coinbase rewards, the new STX that's being introduced in the system. But if you start getting more smart contract usage, which is the main thing we're trying to do, we're trying to bring all the different smart contracts to Bitcoin. Then because the value of the block goes up, that means the miners are willing to bid higher for those blocks, and the value is actually going to the STX holders who are participating in consensus.
Okay, that's definitely very fascinating. So tell us what you think. To all the audience watching this, be sure to post your comments and thoughts down below. I am going through them and trying to bring them up into the interview.